Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Wow. It's very interesting, I think, what's happening right now. And when they say it's different this time, and I know you guys are tired of hearing me say it's really different this time, but you know what? Still true. It's still true. In fact, that's one of the things that you can count on in life is change. Whatever's happening now is going to change. And hopefully for the better. And I'm looking at a lot of things. I see there are lots of companies now that are investing heavily. You only hear about the ones that are laying off, incidentally. But there are a ton of companies investing hundreds of billions of dollars in infrastructure that's really going to help not just America. It helps all over the world. And I'm sure a lot of other countries are going to try and do a lot of the things that we're going to be doing here over the next 10 to 15 years. And I'm just amazed that things are going as well as they are, given the fact that, there's a major world war being fought right now. We're just a substitute participant. We're not actually participating directly, but indirectly. And so, things are actually, it's pretty amazing. In fact, I'm really pondering, whether in the past I've done a couple of websites. They turned out to be too much work. And people would get in and they would forget their password or user ID. And that was just. And then I had one individual. I forgot what he did, but somehow he managed to change and lock out everybody, including me. This was a long time ago, before the technology was quite as good as it is now. And so at any rate, I think I'll probably start off with just a blog. Here's a blog. And because there are things like, I'm pre-recording this, and you guys are going to get at least a 4 or 5 day heads up on this. But I'm looking at Intel. After all these years, I'm looking at Intel, and I've owned it before. In fact, it's in a lot of the ETFs that I invest in. And one of the reasons, a little bit later in today's show, I'm going to talk about why I chose the ETFs that I chose, why I think it's a good idea that you might want to take a look at those if you have to keep up with it. Rebalancing your portfolio is kind of important too. We'll talk about that. And we're going to talk a little bit about individual stocks, and that's where I'm going to begin right now. I've gotten lots of requests for people that just love the stock market, and I get it. It is so nice when you see a stock that you've actually made a lot of money on. You look back at it, wow, I had no idea when I bought that it was going to do that well. Same thing with funds. I mean, it's hilarious. I had forgotten completely about this investment I'd made a long time ago, and just didn't know. I literally forgot about it because I invested directly with the mutual fund company, and then I moved and I give them the address, And by the way, almost nobody invests directly with a mutual fund company anymore. That is so rare. But they have the certificates, they have your money, and the investment showed up again because Fidelity, which is one of the custodians I use, had purchased that company, and they got that account. So I will log into Fidelity, and I'm like, hey, what the heck? I remember when I owned that fund, but it was worth 7 times more than I had put into it. And I was just going, holy cow. That's how long it was, by the way. It was a long time period, more than 20 years. But I think it was closer to 30. In fact, I'm sure it was. But that's crazy. And that was a normal stock fund. So when you're investing, and by the way, had I been investing it in one of the ETFs that I invest in now, and they weren't available back then, by the way, would have been as much or more. So when people say you need to be long-term investors, that's what they're talking about. You really need to be looking out long-term. And I know the biggest problem that the vast majority of investors run up against is they try to predict what the market's going to do over the next couple of years. And a lot of people are trying to predict over the next 6 months. Bad idea. Horrible idea. You should be looking over the next 10 to 15 years. And that's a minimum. 10 to 15 years. You say, yeah, but I'm 90. You think the market cares how old you are? Market doesn't care how old you are. Market's going to do what the market's going to do. And it's up to you to have a plan to be familiar with how the market operates and put your portfolio together so that it coincides with how the market operates and what you can withstand as an investor. Now, when I say withstand, it's because you're going to put up with volatility. You won't be able to avoid it. It's just going to happen. That's the one reason. That's one of the reasons that these annuities are so popular now, is because they're tax deferred and they pay an interest rate that's higher than CDs or treasuries are for the vast majority of them. You got to shop around. And by the way, before you do when you hear anything on this show, it's not construed as individual investment advice. You need to talk to your investment advisors about that. Get professional opinions. I'm telling you what my opinion is here, but my opinion may not be right for you. Some people don't belong in the stock market. Some people don't belong in fixed annuities. Some people don't belong in anything other than CDs. And actually, a lot of people, that would be the safest. You can get a money market account now that's paying somewhere between 3.5% and 4%. Some of them are paying more than 4%. I use a short-term bond fund. Its current yield is 4.9. But those fluctuate. Even CDs fluctuate, believe it or not. And I know if you're much older, you probably don't believe that. But I'm telling you, if you put that CD into a brokerage account, if you were able to buy and sell it, they call them brokered CDs, you would see that the prices fluctuate a little bit. Not a lot, and depending on how long the maturity is, but they do fluctuate. But right now, it's been a big help, and it's gonna be a big help. It's it'll ding the financial firms out there. I mean, publicly traded stocks. I'm sorry, publicly traded companies. It's going to hurt their profits a little bit because they refinance their inventories quite often, depending on the industry. So when their costs of borrowing go up, that comes right out of their profits. So profits are squeezed just a little bit. And one of the reasons I started off talking about the stock of the week was because I'm looking through the scans that I run every day, and Intel comes up. Man, I haven't owned Intel outside of the positions that it has in the funds that I hold, and it's in there. But I haven't held a direct position in it. I mean, I haven't purchased their stock in years. And it was a very good performing stock for a very long time, but it got so overpriced. And I had held on to it. It was up 100% more than I thought the company should have sold for to begin with. And then it kept going. And then, of course, it crashed. And that was a big crash. Remember 2000? That was huge. And then it took years to make that back up. So, but what I'm telling you now is that, first of all, semiconductors are much more popular than they've ever been in the history of technology. Why? Because there are toys that have semiconductors in them that are stuffed toys with animal voices or just voices. And they're using semiconductors to do that. I mean, think about that. The average car has got a couple thousand semiconductors in it. And I was so upset when I was driving in this morning and my flasher would not turn off. That's one of the, I'm sure that's not due to a semiconductor, but yeah, it seems like, the more complicated the technology gets, the more frustrating it gets. And I don't know, ever since the pandemic, incidentally, vendors like banks, brokerage firms, insurance companies, going to their websites has been a nightmare. And I have to take a flight out of here a little bit later today. And the airline, I'm not going to name them, but the airline I'm using, you just have to get on the phone and call somebody. You can't use their web. It's not usable. And so the reason I'm saying this and telling you this is because I know a lot of people sit around and they get really frustrated when they try to do something on the internet and they think that it's them. They think that they're trying to do something. And so I am so thankful I took that class in programming way, way back just to get an idea of what is supposed to be happening so that when I see that what is supposed to be happening is not happening, I know it's not me. And there is some really bad code out there. I mean, some really bad code. And it's amazing. But if you're having problems with your websites, logging in, saving whatever, there's a really good chance. I would say there's about a 4 to 5 chance that it's not you. Now, 1 out of 5 times it's probably going to be you. But I'm serious. 4 to 5 times it's not you. What does that mean? Well, it means that the technology companies have a lot of work to do, which is pretty good. Keeps people employed. Now let's get it fixed. So just kind of being a little facetious there, but realistically, though, technology companies are a driving force in this economy. Have been for the past 100 years, actually probably a couple 100 years, and will be in the future. And one of those, like I was talking about, is Intel. It's got a really nice dividend. Just look it up. I've got it in, it's probably in 4 of the funds that I own. So which probably brings it up to about a 1.5% position overall. I think I'm going to bump that up to a 4 or 5 by buying the shares on my own outside of that. And I think it's just do I expect it to fly up really quickly? Heck no. In fact, it could drop easily from the price that it's at now. Any stock can. And don't believe people who say they can predict what's going to happen in stocks. I see this all the time. It just, my entire career, it's driven me nuts for 30 years. I don't let it bother me that much anymore, actually. But you just have to be careful. And as soon as we can, I guess I'm going to try to get a seminar together out earlier or later this spring, maybe early summer. And we'll talk about how do you go about to look up this stuff and I'll show you the stuff that I use, and there is a retail version of it. There is information on Fidelity that's free that normally people would be paying a couple $1,000 for, and if you know how to access it, it's free. So that's pretty good. It's a little more work, a little more labor intense, but that's why it's free. But it does have all the information that you need to make a really good estimate of what you think a company should sell for. And even if you're a professional analyst, hey, I hear the music. This is Bill Bullington. I'll be back right after these messages.
pray in Jesus' name. It may be midnight or midday. It's never early, never late. He gon' stand by what he claimed. I lived enough life to say help is on the way, round in the corner.
And
Help is on the way, coming for
I really like that song. Yep. Along those lines, help is along the way. I'm here to tell you, I see a lot of stuff and I hear a lot of stuff, and there's some really, really nice ads. I keep meaning to tune in to listen to some financial planners that are showing up on the Fishes shows all over the place, and they have really good commercials. And one of the things about my industry, and one of the things I try to help, and hopefully that these planners are along these lines, is to try to make this as simple as possible. See, the simpler something is, the less likely it is to go wrong. If you got something that's really complicated and it involves thousands of moves and you've got to be highly accurate, wow, that's tough. I like things that are relatively simple, where you can make some minor adjustments or major adjustments simply, easily, so that if something unexpected happens, you can be prepared for it and just make the change. And it's like financial planning. I think this is pretty funny. I keep threatening to write a little book, and I will eventually. But I wrote the one little book on how to value a stock, and that's called Look Out for the Bull. You can get it on Amazon. And it's like 36 pages. I think it's only 3,500 words. And basically it teaches you how to give an estimate of earnings and then take those earnings and figure out what the share price should be from that. So I actually took the workbook and the kit that I bought back in college from the Individual Investors. I can't even remember the name of the, it's been so long ago. But if you go online to look for it, Association of Individual Investors, something like that. American Association. I think that's it, AAII. Anyway, I it's been so long, and most of the time I just do this in my head. I look at the numbers, and I've been doing it for so long. It's just not that hard. And it's a relatively simple process. We all put so much thought into all these things, and I've done it for my entire career. And the reason that I did it for the first, probably 10 years that I was in the industry was because individual investors like you were calling me and trying to hold my feet to the fire and demanding, how much is this company going to earn? What is it worth? Have you ever seen the long-term chart of a stock and then go back to see what the average fluctuation is? It's around 50% a year. That is no joke. New York Stock Exchange, back in the late 1980s, okay, when I first got in this industry, both Peter Lynch and Warren Buffett said, if you can't stand to see the value of your stocks drop by 50% or more, don't buy stocks. I thought they were kidding. I literally, when I was new to the industry, I thought they were kidding. Then I got those graphs from the American Association of Individual Investors. Yes, that is it, AAII. And I started filling them out. They put the sales, the earnings, and the share price range for the year all on one line. You created this little graph, and then my heart nearly stopped. I was thinking, how on earth does anybody invest in something like that? Something that's going to be going up so much and down so much. Well, if you're going to invest in stocks, that's what you're in for. That's why the things like a fixed index annuity, the fixed index annuity, the guaranteed rates on it are higher, according to Dalbar. Dalbar is a nonprofit company who studies investor behavior, and they put out this list every year. It's actually a report every year showing what the average investor does. Now, the average investor has actually been improving slightly but when you see what they're doing over the long run, stuff is really hurting them. And mainly it's because they don't know. They don't know what I'm telling you. The vast majority of people in my industry don't really know because it's not on the CFP exam. And the way that they explain this kind of stuff, that's modern portfolio theory. Go Google what Warren Buffett has to say about modern portfolio theory. It is in the long run, and to give these guys a break. I know the academics, people lean on them really hard, and they've got to come up with something. They got to come up with. So this is what they come up with. It's a model, and does the model work? Well, if you have the model in addition to a crystal ball that works, that's going to be pretty good. If you don't, you'd better have a good understanding of what makes businesses grow their sales over time, because that's the most important thing. I'm telling you, and it should. I'm thinking that once you've gone through one of that course for the NAI, and if you want to see. Want a link to that website? I'll look it up for you. Go to my website or just email me, Bill at Bullington Capital. If you go to my website, go to the contact us, say, I'd like the link to get that course. And you can self-study this. I did it when I was in college. I was probably a junior. And spending $35, I still remember how much it cost. That was a lot of money back in 1985. So, but I sucked it up, spent it, did the work, and I was like, oh, that's how that works. Yeah, that's how that works. And now what's really good about that is when I'm reading an exchange-traded fund, I can talk, just like the guy that came on last week on the show. He was talking about a specific industry, and they got an exchange-traded fund. And I think if you have a lot of interest in that area, I think theirs was the cybersecurity. That's a good way to get exposure there. When you try to pick the one company that's going to be the winner, now you're taking a really tough task and you're making it even harder. So if you think an industry is going to be good, I'm telling you, there's an ETF out there that's investing in it. Don't waste your time doing the research on individual securities, especially if it's something relatively new to you or if the industry is less than 20 years old. If cybersecurity is right around 20, okay, that's one of the reasons I let him come on and talk about it, because there are a lot of people doing it. But bottom line is you really need to know a lot about the companies. And I feel so bad I've gotten so deep in the weeds here with individual securities and how to do investment research. That's basically what we do. And I'm telling you, I'm suggesting that if I didn't do what I do for a living, I would go try to find somebody that would answer my questions, who calls me back, okay, and points me in the right direction and assists in that. And once you understand the process, then you can relax. And that's the main goal. Every financial advisor would love to be able to have all their clients relax, knowing that, hey, we put this investment portfolio together to fit your lifestyle based on what you requested and what you felt you would be comfortable with. There's a problem, and a lot of PhD psychologists call this cognitive dissonance, when what you see is not what you want, and you start seeing what you want to see anyway. That's a little bit of a problem. And so I'm very blunt as far as that goes. And again, that's how I like people who are blunt. Just tell me how it is. You don't have to be rude. There's a difference between blunt and rude. But I just want to know, what am I up against? What is this going to do? How much is it going to cost? What am I going to reach the goal that I'd like to reach? And, it's a big deal. And again, I know I promised earlier I was going to give you a financial planning, a simple financial plan. And I am right now. You don't even have to write this down. You can go to, what is it? thefish.com, or it's on being broadcast on the Fish's website now, 955 The Fish. So if you just Google that, it's also on my website. And here's what you need to do. Take your current income. If you don't know, by the way, if you don't know what your average monthly expenses are, the first thing I would suggest is that you try to track that and just sit down once a month. Just write down what you paid in bills that month. Well, how much did you pay for your cell phone? How much did you pay on a car payment if you have one? How much did you pay in insurances? You know, I might have to break that out because they might only bill you. I think I pay mine like twice a year. But the how much is your mortgage? You know, how much are you spending on food? And that you might have to go into your statements and whatnot. And it could just be how much do you think that you're spending on food? Just write that down. Just do that. You know, I would do it once every other year just to see how much do you need to save to be able to replace that. Well, you take that number, whatever your basic living expenses are, and to replace that number, you need to multiply it by about 20, maybe 25. Fidelity says 8. Well, that's because they're counting the Social Security, the average Social Security, and they're doing an average. And by the way, this is an average as well. Everybody's a little bit different. Another reason I have a job. Everybody's a little bit different. So you need to customize. Some people are comfortable when they see their portfolio down by 40, 50%. No sweat. Hey, I'm in it for the long run. No problem. I understand. I knew it might happen. You know, I'm not happy about it, but I understand it and I'll live through it. I'll make it through it. But if you're not comfortable with that, then you definitely need to do something other than putting all your money in stock funds or stocks, because there's a really good chance if you've got all your money in stock funds that it'll be down 50% sometime. Now we're so where are we going to invest the other money? Well, the other money is going to go into fixed income. Fixed income is a good category. It's gotten a lot easier for people to choose over fixed income now because bonds and CDs are paying a lot. Fixed annuities have been raising their rates. So you have better choices than you had a year and a half to 2 years ago, like much better. And that's a good thing. I'm not sure I would take it. Right now, the 2-year Treasury is hard to beat for a taxable account. So it's a taxable account. It's really hard to beat. If you want a tax deferred account, you can get higher rates in annuities, but they come with different caveats, and they're all over the map now today, by the way. The vast majority of them have penalties if you submit a surrender form for the whole thing. So if you wanted to take all the money, and they vary, I'm telling you, it's across the board. So if you are interested in something like that, which I think they make a really good place for most people, especially the fixed index. See, the fixed index gives you the choice between the fixed, the guaranteed amount, or the index that it's investing in. And you don't have to make up your mind until after the fact, which I think is really good. When I first saw that, I was going, what? You know, really? But so those are a really good option. If you're looking for higher income than you can get on a CD or a Treasury, you're looking for something that's guaranteed. If you put taxable money in there is, and you're not taking it, the interest that's accumulating or the benefits that are accumulating tax deferred. I hear the music. That means I'm going to take a real quick commercial break. You listen to Bill Bullington right here on 1420. Stay tuned.
Child of God, on my worst day, I'm a child of God. Oh, every day is a good day, and you're the reason why I'm so blessed. I'm so blessed. Got this heartbeat in my chest. No, it doesn't matter about the rest.
The other day I was thinking to myself, made a list of all my mistakes. Oh, I wish I could have run to you and tell you all about my heartbreak. And I wondered to myself, wait a minute, am I even on the right path now? Had a couple wins, but I got knocked down. But I know that you are here right now.
We're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can go to my website, bullingtoncapital.com, if you'd like to get in touch with me. There is a contact us form there. And I'll tell you, that reminds me of the technology. Sometimes we're not getting the emails for a couple of weeks. I'm not sure why, and it's not constant. When I try to log into my on the internet from where and I'm just right outside of, I'm in Fairlawn actually, and it's amazing how many times during the weekend days that the internet goes out, and it's just mind-boggling. And so I live not too far from there, and the internet I have at home, it's just been going out in and out a lot. So again, if you think you're having problems, I mean, you can always contact your internet service providers. I have them occasionally. I'll have Spectrum reboot my connection, and sometimes it fixes it, and sometimes not so much. But it's just the way of the world now. In fact, I've it's very frustrating. So believe me, it's not you. This is just the way that things are going right now. And over the past couple of years, it's actually picked up intensity. And I have a whole bunch of conspiracy theories on why that is, and I won't bother telling you about it. Just kidding. No, I just understand that there are a large number of hackers out there. There are people, they're fighting back, and they're trying to protect people from getting taken advantage of. So all that stuff slows everything down, and it goes way beyond my pay grade. But anyway, so don't feel like it's you. And it's one of the reasons that, a lot of people come to us, because there's me, Larry, Melissa and Gary. Just put their names together. But we have a team of 8 people at one of the biggest brokerage firms in the country, and it's Fidelity. They work with us, and then they put us in touch with whoever the department heads are, or the people that are supporting in departments for anybody that we need to help. And it's nice. I mean, it's really nice. Is it frustrating? Yeah, because again, connections go down. Well, that's the nice thing about having us and our team at Fidelity. And Axos has got a team there. Axos bought out the old E-Trade Advisors, and they've got a team there that also helps us with their stuff. And we have very little at Goldman Sachs left. Yeah, I've got a little bit. And they're pretty good too. Actually, their service really, when Goldman Sachs bought this firm, it really helped. So we have 3 basic vendors, and all the paperwork that needs to be filled out, this is one of the things that makes it very difficult for people in today's modern age. So much legislation is put into, in other words, they're creating new laws. And the laws that they create, I have no idea where they're coming up with these. I mean, it's unbelievable how many hundreds of thousands of pages have been added in the last 5 years. And I'm not kidding. So it makes it hard. I feel bad for everybody, me included. I have to deal with it myself. Trying to keep up with it is not easy. In fact, I'm on my way to a class in Social Security just to keep up with the changes in Social Security. And that's just Social Security, by the way, which is a big deal. For the vast majority of people, it's going to be a big portion of what's going to enable them to retire. If you look out across the country, the average household income, I think, is somewhere around $70,000. And if you look at what they're going to get in Social Security, it's probably about a third of that. In Social Security, a third is a lot. You talk about a couple $1,000 a month, and that $24,000 is a lot of money. You'd have to have about $600,000 sitting in CDs to produce that. Now, how do you like it? And think about that. That saves you from having to save about $600,000. The average household, they don't have to save that $600,000 because they'll get it in Social Security. Now, if you'd like to double that, then you're going to have $600,000. But you're halfway there. And if you want you want to make $1 million a year in retirement, Well, you need about $25 million for that to do it risk-free. Okay, so that's a long shot. And I think I have one client, actually, that would fit in that category. And I don't think he's going to quit ever. But the bottom line is takes a lot of money to be able to retire comfortably. And when you have, let's say you've got half the money that you need for retirement, or maybe a third or whatever it is, the other portion that you're going to need, just multiply that other portion by 25. And that's what you would need to be able to do withdrawing 4% a year, understanding that you're going to have to increase that over time. And that's another thing, another mistake a lot of people are making. They hear, well, this is great. I get a 5% CD. I got my 4%. I don't have to take any more risk. Sorry. There's this thing called inflation. You may have seen it at the grocery store. And that's a problem. So you're going to have to earn more than 4% of this. You're only going to spend 4% a year. But you're going to have to earn more than that, because over time, inflation is going to raise prices, and you're going to have to keep up with that. So again, this is it's pretty difficult. It's just not easy. So, and by the way, so here's what I started to talk about this super simple retirement plan. Find out how much you need to live on now. And if you don't know what it is, I'll give you a rule of thumb. Most people could probably make it fairly comfortably on 75 to 80% of their pre-retirement income. So if you make 100,000, you could probably get by on 75,000 without a whole lot of pain, because you're not going to have to keep driving the same car. You're probably going to go on Medicare at some point in time, and it should lower your health care costs somewhat. You're not going to be saving for retirement anymore. That's a big one. And oftentimes, if you're lucky, your kids are out of the house. Just kidding. Kind of. I've seen a lot of instances, and that's life. But so the bottom line is, you got about 3/4 of what you made pre-retirement. You should be able to maintain the lifestyle that you had without much of a problem. So just multiply, whatever you're making now, multiply by 0.75. Then get online, open up a Social Security account, because if you're not keeping up with that and they get your earnings wrong, they got mine wrong. It was just such a long time ago that it's not really going to matter that much. But that was before they had online access. And had I known, I would have said, hey, no, you got my income wrong that year. And that was like 25 years ago. But thankfully today you can set up a web access to it. It might take you a little while, again, because this is a government institution and it takes them a long while to do everything. But the bottom line is go over there, set up an account, and start getting your statements. You can go in and download them, check them out, see if you see something wrong there. If not, that's okay. Take that number and just remember it. Now, they do adjust it for inflation. Now, whether or not it actually keeps up with the real inflation, that could be debated all day long. But they're going to try and keep it adjusted for inflation. So when you have your number of 75% and you get that Social Security number, this is where it gets a little complicated, and this is something that I'll help you with, no problem, because we do it all the time. If you were retiring today and you made 100,000 and you're going to get 25,000 in Social Security, okay, and I'm just let's say 30,000, 100,000. Someone making 100,000 probably getting 35,000. Yeah, okay. So let's say 35,000. And 35,000, you need to come up with 40,000 to be at 75,000, which is 75% of your $100,000. Okay, so that's $40,000 that you got to come up with on your own. Now, that's good. If you take that, divide that by 4 or 5, divide it by 4. I've got another tool for this, by the way, too. BlackRock, you may have heard of them. They're one of the largest asset managers on the planet. they have a website for financial advisors, and so they'll project what your potential income might be. And if you'd like to see that report, I use it all the time. It's so efficient. It's a simple report, and everything that I just talked about, it asks and it incorporates that into the plan. And literally, if you know what your current income is, and you know how much you have in savings and how much you're saving now, I can do that plan in about 15 minutes. That's because I've been doing it for a long time. Okay, so, and I'll offer that. If somebody wants to see that, hit me up. Go to the website, say, Bill, yeah, I'd like to see that BlackRock report on my situation. I'll call you back, get the numbers that I need, put it in and get it right back to you. There's no cost for that. So if you're a client and you haven't done that already, then hit me up. It's fairly simple. That's one thing I really like about modern technology. If you are keeping up with it, it does make your life really simple. There are some things that you can do that would have taken, with spreadsheets and calculators, that used to be a 2 to 3 hour endeavor. Now, once you've got the information, it's like less than 15 minutes. So because it's doing all the hard work for you. And you can change the scenarios around and play with it. And so you can do 4, 5, 6, 7, 8, 10 plans in less than 2 hours. Not that you ever really need to do that, but when you're learning the software, I used to do that quite a bit. So I think it's a really good value. Comes from, the world's largest asset manager. They're actually bigger than Fidelity or Vanguard, by the way. And they're called BlackRock. So not everybody hears about them, although most people do. They're, I shouldn't say most, a lot of 401k participants, because they are included in a tremendous number of 401k plans. And most of their investments are basically, they're called quantitative or factor-based. Factor, what is a factor? Factor means, okay, we're going to look at a profit margin. Companies that have bigger profit margins make more money for every dollar's worth of sales than the companies who have the smaller profit margins, right? Does that make sense? So that's one of the factors that they'll use. They use profitability. And they use that in several of their ETFs. Actually, there's probably a dozen of them that they use that in. The next factor that's really important is size. And I'm talking about the size of the entire company. I'm not in a total agreement with that. And by the way, the S&P 500 is size only. So you can be in the S&P 500 and you can be losing money. And a lot of companies, a lot of stocks will get popular and their share price will go up. That will make the fund buy more shares, despite the fact that they may be still losing money. And in the long run, that's okay. It'll wash out in the end. And in fact, it's incredibly difficult to do better than that model. And that's one of the things I found really frustrating. And it's not because the managers are getting dumber or anything like that. It's because there's a lot of money flowing into those types of funds. And I just got the high sign. I only got about $1.5 million left here. So I want to leave that there. We'll pick this back up next week. But again, remember, we've got a planning tool we can use for you. It can be done over the phone or even over the internet. No problem. Email I'm suggesting. And feel free to go to my website and request that. It's bullingtoncapital.com. If you like this show, please send us a nice comment. I'd like to hear that from time to time. If there are subjects you'd like me to talk about, please pick that up. Again, I'll be out the rest of the week at a Social Security seminar. But lovely. And anyway, so this is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can go to my website, bullingtoncapital.com. My phone number at my office is 330-715. Oh, almost gave out my cell phone. It's 330-664-0700. 330-664-0700. And we put out I put out a newsletter for anybody that goes to the website and wants it. Believe me, nobody's going to call you unless you want them to. I have a really difficult time getting back to everybody that is calling me now. So if you write in your note, please do not call. That's fine. Actually, that's very good. That helps me because it'll give me, I'll know that if you really want the help, then I want to be there. But if you don't, you're just looking for some information, that's fine. That's fine. If you just want to be added to the website or the newsletter, that's fine too. It's a really good newsletter, by the way. I'll talk a little bit more about it next week. Now that I hear the music, I got to go. This is Bill Bullington right here on 1420. Have a good weekend, everybody. Good luck. Good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.